So I guess the question is this it? Do you consider rates to be accommodative enough now to achieve your goal of sustaining the expansion? And as far as Global Wall Street's primary question, what kind of change in the economy would cause you to reassess? Some sort of significant deterioration in what?
So what we've said, to repeat, is that we see the current stance of policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook. And we say that really because both of the performance of the economy and the stance of policy. The performance of the economy has been, particularly the household sector, has been strong, has been resilient, with low unemployment, attractive levels of job creation, wages moving up, labor force participation moving up, household confidence, and solid gains in many measures of consumer spending. The manufacturing sector, particularly manufacturing and also investment in exports, have been weaker, but overall we've seen moderate growth, a strong labor market, inflation moving up. We see the outlook as for more of the same. We also see the risks to the outlook as perhaps having moved in a positive direction over the course of this intervening period, although some things remain to be seen. So that's the economy. Turning to policy, we've moved the stance of policy over the course of the year to a more accommodative stance. And after cuts at the last three meetings, the federal funds rate is now in a range between 1.5% and 1.75%. We feel that policy is well positioned to support the outlook that I described. So you ask what it would take, to move, and as I mentioned, we're going to be watching all factors. And if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. But that's what it would take, a material reassessment of our outlook.
If I could follow up, if the markets decide that you need to cut rates again, will you be forced to follow?
We'll be looking at a full range of data about the economy and about the risks to the risks to the outlook. And I've given you a sense of what our outlook is. It's for moderate growth, a strong labor market, and inflation near our 2% objective. If something happens to cause us to materially reassess that outlook, that's what would cause us to change our views on the appropriate stance of policy.
Heather. Hi, Heather Long from the Washington Post. You just said that the risks to the outlook are moving in a positive direction. I'm wondering if you could specify, is that on trade or are there other matters? This morning, we obviously learned that we've now had 2 quarters of contracting business investment, which would seem to be moving the outlook in the other direction.
So in terms of risks, what I was referring to there, the principal risks that we've been monitoring have been really slowing global growth and trade policy developments, as well as muted inflation pressure. So I was really referring there to trade developments. We have that phase 1 potential agreement with China, which, if signed and put into effect, could have the effect of reducing trade tensions and reducing uncertainty, and that would bode well, we think, for business confidence and perhaps activity over time. So that has the potential for being an improvement in the risk picture. Brexit, I would say as well, it appears that the risk of a no-deal Brexit seems to have materially declined. I think on both situations there's plenty of risk left, but I'd have to say that the risks seem to have subsided. You ask about business investment. And that's right. Business investment has been weak, and today's reading was weak as well. And it was broad across equipment and other parts of all parts of business. Fixed investment were weak. That's consistent with what we've seen. But that's the economy we've had this year. What we've had is an economy where the consumer is really driving growth, and personal consumption expenditures were almost 3% in this quarter, in this first reading for the quarter. So overall, we see the economy as having been resilient to the winds that have been blowing this year.
Can I just follow up quickly? I mean, there's this concern that I sometimes hear that with businesses have cut investment, and are they going to turn around and cut employment, if they continue to be concerned. Can you give a sense of how the committee is thinking through that possibility?
Yes, so that is a risk. That's a risk that we've been monitoring, but we don't see it yet. We don't see rising initial claims or layoffs or anything like that. But the risk you mentioned of the weakness in the manufacturing and export and business investment parts of the economy getting into the consumer side of the economy, we really don't see that. What we continue to see is good job creation. Unemployment has declined again in the household survey, is now at a 50-year low, has been at very close to 50-year lows for 18 months now. So it's a very positive. The consumer-facing companies that we talk to in our vast network of contacts report, that consumers are doing well and are focused on the good job market and rising incomes, and that's their principal focus. So that is the thing that's pushing the economy forward, and it doesn't seem to have been affected so far by weakness in the other areas.